47,000. That number just appeared on the stock market screen in October 2025, marking the first time in history that the Dow Jones Index has reached this record high. But at the same time, when you scroll through financial news pages, you'll see a completely different picture. A prolonged U.S. government shutdown, an escalating trade war, persistent inflation, and a labor market showing signs of weakening. This is the greatest paradox in the current market. While everything around seems to be collapsing, the stock market is flying high. Just a few months earlier, the S&P 500 had recorded a 36% gain over 6 months, after rising more than 25% for 2 consecutive years before that. These numbers are not only impressive, they are challenging every standard of economic logic. Analysts are confused, investors are wondering, and the biggest question everyone is asking is, why is the stock market still standing so strong? The answer doesn't lie in the simple explanations you often hear. It's not just about the Federal Reserve or interest rate cuts. It's not just about an inflating financial bubble either. In fact, the real reason behind the market's incredible resilience lies in a unique combination, a trio of powerful forces that few people truly notice. These 3 pillars are quietly supporting the entire market, and once you understand them, the picture of the economic future becomes clearer than ever. This story begins on an afternoon in September 2022, when I sat in a conference room with dozens of institutional investors. The atmosphere was so heavy it was almost suffocating. The S&P 500 had just lost 25% of its value, and everyone believed the bull market was dead. A veteran fund manager with over 30 years of experience declared with absolute certainty, "This is the beginning of a lost decade." That day, October 12, 2022, marked the bottom of the market, and since then, the market has risen more than 67%. So where did that fund manager go wrong? He failed to see the 3 hidden pillars, the 3 forces that I'm about to share with you. The first pillar, the AI revolution, when the future becomes the present. Forget everything you think you know about artificial intelligence. 2025 is no longer the time when people talk about the potential or future of AI. This is the time when AI is creating real money, real profits, and is fundamentally changing the way the global economy works. And this is the first force that is powerfully supporting the stock market. Let's look at the concrete evidence. Nokia Corporation, a company that many believed had long passed its golden age, just reported a 9% year-over-year increase in revenue with its optical networks division, essential infrastructure for AI systems, growing particularly strongly. The London Stock Exchange Group has raised its 2025 EBITDA margin forecast thanks to a surge in demand for AI-related technology. These are not promising AI startups with no profits. These are traditional, established businesses that are actually making money from the AI wave. But what's even more impressive is not just that these companies are making money from AI. The more important thing is that they are investing at an unprecedented scale. Microsoft, Meta, Alphabet, Amazon, all are pouring billions of dollars into AI infrastructure, data centers, specialized chips, and research and development. And this is the key difference compared to the dot-com bubble. They were not just spending in hope, they are seeing real, measurable returns on their investments right now. The Federal Reserve released an important study in October 2025 on global AI competition, showing that the United States is leading by a wide margin. While China has built hundreds of new AI data centers, up to 80% of their computing capacity is unused due to quality and connectivity issues. In contrast, American companies are not only investing more, but also investing smarter, focusing on inference and real-time processing, where AI actually creates commercial value. And this is why it matters for the stock market: labor productivity. History has taught us a crucial lesson. In the late 1990s, the internet created a productivity boom, an explosion in labor productivity that drove the stock market upward for nearly a decade. Today, economists at the Federal Reserve are carefully observing signs of a new productivity boom driven by AI. Recent studies show that AI could improve labor productivity by 20% to 40% in certain industries. If this trend spreads across the entire economy, we were talking about a structural shift that could sustain economic growth and corporate profits for years to come. Many people worry that AI is just another bubble like the dot-com era. But there is a fundamental difference. During the dot-com period, companies had high valuations, but no profits. They were burning money with the hope that one day they would become profitable. In 2025, AI companies are making money right now. They have real profits, positive cash flows, and most importantly, they are proving that their AI investments are delivering specific, measurable returns. This is not a story of hope and promises. This is a story of results and reality. The second pillar, corporate profits. Numbers that cannot be denied. If AI is the technological engine, then corporate profits are the financial engine sustaining the market. And this is where the story becomes truly impressive, because numbers don't lie. 2025 is expected to close with high single-digit profit growth. But the more interesting part is that 2026 is forecast to reach 12 to 13% earnings growth. Let those numbers sink in for a moment. This is strong profit growth, especially when you consider that these forecasts already account for all the existing risks: an escalating trade war, persistent inflation, and a softening labor market. Despite all that, corporate earnings are still growing strongly. But here's what most investors are missing, and this is also why the 2025 market is far healthier than it was in 2023-2024. In the past 2 years, nearly all of the S&P 500's gains came from a small group of tech giants, what people called the Magnificent Seven. That was a narrow market, driven by only a few massive tech names. In 2025, the story has completely changed. Financial companies hit new all-time highs in September. Industrial firms broke records in October. Even the utilities sector, usually considered boring and stable, reached historic peaks. This is the sign of a healthy market rally, where many sectors are participating, not just a few tech giants. When the market broadens like this, it tends to be more sustainable and less risky. And where does this strength come from? From American consumers. Despite ongoing worries about inflation and high interest rates, consumer spending has accelerated, growing at an annual rate of 2.5% since the end of March. Why are consumers still able to spend so strongly? Because U.S. households have record net worth thanks to rising stock and real estate values. This creates a powerful positive feedback loop. Rising markets increase household wealth. Wealth drives consumer spending. Higher spending drives corporate profits. Profits drive the market even higher. Many argue that the market is too expensive, and yes, valuations are high. The S&P 500's forward P/E ratio is near the top of its historical cycle. But let's put this in proper context. When you have profits growing 12–13% a year, a higher-than-average P/E ratio can be entirely justified. The market isn't paying for dreams or speculative bubbles. It's paying for real, measurable profit growth. Furthermore, according to Morningstar's analysis in September 2025, not everything in the market is expensive. Small-cap stocks are trading 16% below fair value. Value stocks are 3% below fair value. Growth stocks are 12% above fair value. That means there are still plenty of investment opportunities for those who know where to look. Only 3 sectors remain undervalued: real estate, energy, and healthcare. This is a sign of a mature market, where both opportunity and risk are unevenly distributed. The third pillar, FOMO and market psychology, the most powerful force. Now we arrive at the third pillar, and perhaps the most important of the 3, human psychology and the FOMO effect, fear of missing out. Sam Stovall, chief investment strategist at CFRA Research, made a very insightful comment when he said, "We're trading on FOMO fumes." It may sound negative, but in reality, it's an extremely powerful and crucial driver for understanding the market's resilience. After 2 consecutive years of 25% gains, retail investors, who are usually the last to join a bull market, are finally pouring huge amounts of money into stocks. And this is not a sign of a market top, as many fear. In fact, it could be the sign of a bull market maturing and entering its middle phase. Let's examine this psychological journey over 3 years. In 2023, the first year of the current bull market sentiment was skeptical. Retail investors didn't believe in the rally. They thought it was only a temporary bounce before another collapse. In 2024, the second year, there was a shift toward cautious optimism. Retail money was still limited, but at least the mood wasn't fully pessimistic anymore. By late 2024 and early 2025, a critical transition took place. Wall Street strategists began raising their forecasts to double-digit growth for the S&P 500. Retail inflows finally turned strongly positive. This isn't a signal of a market peak. It as a signal of a bull market evolving from its early stage, dominated by professionals, into its middle stage, embraced by the public. History tells us one important truth. Bull markets usually last longer than people expect. The current bull market started on October 12, 2022. So far, it has risen over 67% and entered its third year. And here's an important statistic. In history, when a bull market survives its second year without a recession, the probability that it continues into a third year is very high. On average, successful bull markets gain about 5.2% in their third year. And those that fail, they all end for one of two reasons, either an economic recession or an overly aggressive Federal Reserve. And this is where the Federal Reserve becomes relevant, but not in the way most people think. The Fed began cutting interest rates in September 2025, and the market expects 2 more cuts this year. But the key point isn't the specific number of cuts. It's that the Fed is shifting into an accommodative stance, one that supports growth. It's closely monitoring signs of labor market weakness and is ready to act if necessary. This is what the market calls the Fed put, a safety net that investors trust will appear when things get tough. However, it would be incomplete not to mention the risks that remain. The market is not a one-way path upward. Many things could go wrong. The U.S.-China trade war could spiral out of control. Inflation could flare up again if energy prices surge. The labor market could deteriorate faster than expected, leading to a recession. Valuations are high, leaving little room for error in earnings forecasts. But here's the crucial difference. The market knows these risks. They're not surprises. They've been widely discussed and already priced in to some extent. What's keeping the market stable is the belief that the 3 pillars we've discussed, the AI revolution, strong corporate earnings, and FOMO-driven capital inflows, are powerful enough to withstand those risks. And so far, that belief has proven correct. Other supporting factors. In addition to the 3 main pillars, there are several supporting factors helping the market maintain its strength. The Trump administration's policy stance has shifted from hawkish to more pragmatic, focusing more on tax cuts rather than imposing tariffs. This is important because it reduces fears of a full-scale trade war, while tax cuts can support future corporate profits. Deregulation policies may also boost M&A and corporate investment. In the global context, America's advantage becomes even clearer. While China's GDP growth is expected to slow to around 4.5%, Europe continues to struggle with stagnation, and economies like the UK and Canada face challenges. The US stands out as a magnet for investment. The reason isn't just stronger growth. It's also higher productivity driven by AI, the world's largest consumer market, superior innovation capacity, a skilled workforce, and the most developed financial infrastructure globally. Another less discussed but crucial factor is that companies are returning cash to shareholders at record levels. Share buybacks and dividends are at all-time highs. This creates strong technical demand for stocks. Companies are buying back their own shares, reducing the number of shares outstanding and thus supporting stock prices. This acts as a self-reinforcing mechanism for the market. independent of investor sentiment. Conclusion. So, after examining the entire picture, we can finally answer the original question. Why does the stock market remain strong despite all the negative news and surrounding risks? The answer isn't magic or luck. It's the result of a powerful combination of three major pillars. The first pillar is the AI revolution. No longer a story about a distant future, but a present reality generating real profits today. AI is driving a new productivity boom that could sustain economic growth for years to come. Companies aren't just talking about AI. They're reinvesting massively and already reaping tangible rewards. The second pillar is corporate earnings, which are growing strongly across multiple industries, not just technology. The forecast for 12–13% profit growth in 2026 isn't a distant dream, but a reasonable expectation based on current trends. American consumers remain resilient, and the positive feedback loop between wealth spending and profit is self-sustaining. The third pillar is market psychology, the FOMO effect that's driving a flood of retail money into stocks. This isn't a sign of a market top. It's a sign of a bull market entering maturity.